Hi, this video is a summary video of what we are covering in Unit 4 of Equity Valuation. So essentially this is a short compilation of all the other videos in this particular course. This is just to summarize basically what techniques, advanced valuation techniques we've looked at. There are special cases in valuation that we are discussing in this particular section. Introduction to distressed company valuation, where companies are not expected to be going concerns, right? So you cannot really use your terminal assumptions very easily. You're looking at valuation and applications in M&A, basically trying to value synergy. You're looking at valuation adjustments for young companies because of high growth and many other factors like lack of history, etc. for younger firms. And you're looking at transaction comparable methods, which is similar to relative valuations, but basically bases the value of a company based on other acquisitions in the same sector, right? That's what these four methods are. Let's do a quick recap in terms of what these areas are. When you look at a distressed company, the idea of terminal value becomes a little bit tricky because you're assuming that the company is a going concern. But in real life, companies can default, right? They may be in distress, and that distress could come because of either leverage, huge amount of debt, unfavorable business cycles, some regulatory clampdown by the government, or inefficiencies in the firm, right? Now, how do you adjust this? There are many methods of adjusting the valuation for distress, but we primarily use the method of going concern valuation with adjustment for distress. What does this do? You basically value the company in itself using the same methods that we have seen, and then estimate a probability of distress, right? So if the probability of distress is 20%, then the DCF value, whatever value you found, let's say 1000 is the value, multiplied by 80% because probability of distress is 20%. Plus, what happens if the company is in distress? What is the distress sale value? Let's assume that is 100 here. So that's your expected equity value that you're going to get, right? And not 1000, because 1000 assumes the company to be a going concern. And that's the idea. Now you have to basically do a simple DCF, estimate the probability of distress, and find the distress sale value of equity. How do you estimate probability of distress? For this, you look at the firm's credit ratings, and you try and identify what are the chances that the firm will default. Or historically, let's say a firm with a credit rating of A, what are the chances it defaults in the next 10 years, right? So you can try and find out cumulative distress probability of firms looking at history of a certain credit rating over 5 to 10 years. So Professor Damodaran has done some work on this, and he's found data about distressed companies, and he said that given a certain rating, let's say B, the chances of default in the next 5 years are 24%, and in the next 10 years are 32%. So I can identify the credit rating of the company, and based on that, I can assign a certain probability of default and put that in that formula, right? The next part is essentially distress sale value of equity. It's usually, you can sell current assets at 50 to 100% of the value. Fixed assets might be sold at 20% if the company is in default and you're doing a fire sale of the assets. However, usually if the company is in distress, the equity value you will find is next to zero. It usually is not there. As we see in the example of a company like Suzlon, you find that if you look at the balance sheet of Suzlon, total balance sheet size is 9,600. But if you sell all these current assets at 50%, that's about 70,000. And even if you sell it at 70% of value, you get 4,900 here. Fixed assets, even if you sell them at 50%, you get 1,500 here. These values added together are 6,400, and total debt is much higher. So you will not be able to repay. You're anyway in negative equity at this point of time. So for all practical purposes, the firm is going to do a default, right? So equity value will be zero in the case of distress. And you can assign a certain rating to the fund's bond. So BBB is the rating based on which you can arrive at the valuation of the firm. Probability adjusted value, probability of default into default value, that's 0. 1 minus probability of default into the DCF value, or whatever relative valuation value you've calculated, that value comes here, right? That's the distress sale value calculation that you do. Similarly, in relative valuation, you could either arrive at a certain valuation based on an EV method, EV by sales method, for example, of 2, based on which you get an enterprise value of 1900. You can remove the debt. What you get is the equity value, and then you can use the probability of default once again to calculate the value, just like we did in the DCF calculation, right? So that's basically how do you do a distressed company valuation. The next bit that comes is M&A. So in M&A, companies are typically justifying M&A by synergy benefits. Synergy could be operational or financial in nature. Now, usually the idea is that target company controls some resources which may be put to use by the acquiring firm, and that will create the synergy, right? Now, what kind of M&A exists? Horizontal M&A, where similar firms combine, right? Idea Vodafone, for example. Vertical M&A, where you are picking up a company in value chain. So steel firm acquiring a coal mine, which is a raw material, or iron ore mine, which is a raw material. So you're acquiring in a vertical sense, essentially, right? Functional integration, different kinds of businesses. For example, a retail company might acquire a social network company, right? Now they might have similar drivers and they might be expecting some utilization. That's a functional integration. Synergy could be operating in nature, which is some sort of cost savings or new investments or higher return on investments, which we'll see in numbers there. It could be financial in nature, which could be tax benefits because one of the acquiring company runs losses and hence you carry forward those tax benefits. Better debt capacity, larger companies can borrow more money. Better cash utilization. You know, if one firm could have cash, the other firm could have opportunities, but no cash, right? So how do you value synergy? You first value the firms independently. So if there are two firms, A and B, you value them separately and then do A plus B. Then you combine the entity and value using all the assumptions around synergies. So you value AB, and the difference of AB minus A plus B is the value of synergy, right? That's basically what you are saying in terms of data. Now, what are the effects of synergy? If it is because of economies of scale, operating margins will expand. If it is because of higher growth opportunities, ROE, ROCE should increase. If tax benefits are the case, effective tax rates will go down. If it is due to better borrowing capacity, and then the cost of debt and cost of capital will go down, right? So you'll see these effects in the merger that happens, and that basically works. Let's look at the example of Idea Vodafone. And the best way to look at it is here. So currently, the equity value is given, the net debt is also given for both the firms. So this is A and this is B, right? Enterprise value of the two firms is given. You also have the EBITDA of the two firms. If you calculate the EV by EBITDA, you get 6.33 and 6.38. So you calculate the average of that. The new firm should trade at the same average. You find that there is cost saving, right? There is cost saving that is happening because of the firms merging, and that results in EBITDA going up. This EBITDA into 6.35 gives me the new enterprise value of the combined entity. You see AB is greater than A plus B, right? Because of the two companies getting together, there are some asset sale that could be done because there are duplicate assets. So that is used to repay some debt, and so the total debt is also lower than the sum of these two. You subtract net debt from EV, you find the new equity value, which is significantly larger than A plus B. So AB equity value is 1109, A plus B is 195 plus 276, so that's going to be approximately equal to 470. The difference is my synergy, right? So that's basically why the firms are trying to work. Obviously, there are assumptions here. There are assumptions that rating will remain the same. There are assumptions that operating profit margin will go up, and there are assumptions that debt will be repaid over a period of time. But the combined entity should then obviously trade at significant value in this context, right? That's the synergy valuation. Next, we move to young companies in terms of our summary. These companies, there is a challenge in valuing young companies because there is limited history, they're making losses, thus cash flow is negative. Significant growth rates create a problem of terminal value, and the companies may not survive too long. So what do? We first project revenues, We estimate profitability over a period of time. We assess how much reinvestment is needed. So profitability into 1 minus the tax rate minus reinvestment assumptions for that growth is going to give me HCFF. I can estimate the cost of capital, which may be different in different years of the firm, right? Because this company is basically changing. The company matures, risk reduces, so cost of capital should also change over a period of time. And then eventually we assess for expected failure rate of the business and incorporate that. We'll understand all this very quickly using just a simple example. There's a company whose revenue gets projected, assuming a revenue growth rate. That's step one. Based on this, we arrive at an operating margin number and calculate the EBIT into 1 minus T numbers. That's step two. We note that revenue growth rate goes down, operating margins go up as the company matures, right? Step three, we calculate reinvestment needs. That's step three. How do we calculate reinvestment? Reinvestment here is equal to change in sales by 3. We have just taken an example. Usually you can take it from the industry averages. What's the typical reinvestment happening? That gives me step 3. I look at the cost of capital. That's step 4. And in this, you see cost of capital is going down because risk is going down as the company matures. And then you find the final present value and the terminal growth rate of this company. Terminal growth rate is assumed to be 5%, based on which you can evaluate the firm on a steady state basis. Each year is discounted at a different rate essentially, and that gives you your final value of the company. To this, you put a probability of survival kind of calculation and put that into picture. If it doesn't survive, equity value is going to be 0, right? Finally, we look at transaction comparables. In this, we are looking at transactions, M&A that is happening in a certain sector, and using that similar to relative valuations to arrive at the company's value. We take an example of a company in the hospital segment. There are about 1,525 beds here, for which 2,670 crore value is given. That's equity per bed is what we have calculated here. Here the company is being valued at 7,800 crore, number of beds is 4,900. So you're valuing it at this, which is again going to be approximately equal to 1.7. This is also 1.7. So you're saying 1.7 crore per bed is the value that you're giving, which means if there is a 1,000-bed hospital, your value should be 1,700. That's how we use transaction comparables method, right? This is very similar to relative valuation, just that in the case of relative valuation, you have a functional market, so it becomes easier to find the values. Here you have to kind of search for these deals and identify where these deals are happening. That's in a nutshell the summary of this particular unit. Thank you.